Chris MacIntosh, thanks so much for coming on Wall Street Unplugged.
Thanks for having me, Frank. It's good to be back.
Well, I have to say, good to be back. I mean, we've been doing this probably for about 3 to 4 years having you on, and some of your investments have been absolutely incredible. I would actually put you right at the top of the list in terms of getting into Bitcoin super early, getting into oil, which I didn't really agree with your thesis when you came on. I think it was about 9 months to a year ago. And you turned out to be right, and I was wrong. I just thought it was a little early. But just finding those assets at a misprice, favorable risk rewards, asymmetric investing is really cool. But I want to start off with this. So when are you planning on getting the vaccine so you could travel?
Oh, well, at the moment, I'm just sitting here waiting for my overlords to tell me when I can take some experimental DNA-enhancing vaccine. And I eagerly await them plunging it into my arm on a continuous basis, because getting it once will not be enough. So I'm just waiting, really.
You know, it's funny and it's not funny, right? Because this is probably going to happen where we're going to have to get vaccinated and carry a card around to actually, you know, I know there's some states that DeSantis said you don't have to do that in Florida, but other states I think are going to mandate it. And especially other countries like Canada, I could see that, which I travel a lot to for mining and stuff. But more to the point, we all have our personal feelings, whether we agree or disagree, but this also creates different opportunities, investment opportunities. What are some of the things that you're seeing? Because, you know, I saw you comment, and guys, you got to follow Chris on Twitter. It's very, very entertaining with Capital Exploits. I saw you mention how, you know, ARK and Cathie Wood are continuing to invest in these growth stocks and playing for deflation, but you're going to take the opposite end of that coin. What are some of the things that are opening up because of you're seeing, you know, with the vaccine gets distributed, travel industry, again, it's creating opportunities, and I want to put politics and personal feelings aside, but how are you using that to find investment opportunities?
Well, I think if we just go in 40,000 foot view, what we're experiencing is a breakdown of the international rules-based system that has existed post-Bretton Woods. There's a number of components to that. Deglobalization is one of them. Another one is a shift of political, economic, and human capital, or intellectual capital, from the West to the East. This has been taking place at an increasing trend. It's been an increasing trend for the last, let's say, 10, 15 years. And it's one of the reasons we moved out to this sort of region of the world, but it's now going in through an absolute acceleration phase. So that's kind of the global setup that we find ourselves in, and what it's providing us is we're at a pivotal point where a lot of the trends and a lot of the investments that have succeeded over the last, I would say, even 40 years, but certainly over the last 10, 15 years, that had reached astronomical levels, are changing. The dynamics behind them are changing. So, for example, I'll talk about Cathie Wood. So Cathie has gotten into all of these growth equities. You know, she's throwing out numbers like $3,000 for Tesla per share. And none of the companies, or many of the companies that she's investing in, make any money. Profitability doesn't matter anymore. Now, I come at this from actually having seen a lot of what is transpiring in that space. But earlier on in the cycle, if you remember, I built a venture capital firm for the very reason that I figured out, or I believed at the time, that we were going to have an enormous amount of capital shift into risk growth, quote unquote, growth assets. The furthest end of the risk curve is venture capital, and that's where I went to. That became really, really stupid in 2016, 2017. I sold the business in mid-2016. It got even worse, and we will all remember WeWork and the elevating the world's consciousness and all this kind of nonsense, when really all it was Regis. It just you just sublease bloody buildings. There's nothing fantastic about it. It's a low margin business. It's an okay business, but it's nothing that's elevating anybody's bloody consciousness. But people bought into that nonsense, and we had these ridiculous valuations. That all collapsed. So that whole private equity venture capital space has come under a lot of pressure. But we're seeing this tail end of that speculative mania, and we're seeing it in listed equities. Much of that is driven by both algos and essentially the same thing, which is passive investment capital. So we've had this extraordinary amount of capital that's shifted into non-managed or passively managed indices and that. And there's a feedback loop there whereby the more capital that goes in, the more it sucks in more capital. In other words, for example, you can run an algo, and the algos will be saying, you know what, if this part of the index goes up by 2%, allocate another 2% of capital to it. And by virtue of allocating another 2% of your capital in AUM to that particular sector, it causes the sector to rise more, which then says, hey, if it's now increased by 4%, allocate another 1%, or whatever the case might be. So you have this kind of feedback loop, which is why we're getting, today we have the top 5 companies in the S&P account for roughly 25% of the index. We've never, ever had such extraordinary concentration. Now, if you go back and you remember in the GFC, we had similar dynamics, but it wasn't anywhere near as high as 25%. And that was enough to tip the whole card over. The point is, we don't know when that tip happens, but we do know that it's extraordinary. We do know that it doesn't make any sense. We do know that the valuations that are being paid for a lot of these companies are mathematically, impossible for them to actually, unless every other company sort of goes away on the earth and they end up, capturing not just their own segment of the market, but many other markets that don't make any sense. And so the probability of these things working out in the medium to long term for investors is super problematic. While all of this is taking place, we're having this extraordinary supply destruction. And you've got supply destruction in critical goods, while at the same time you have monetary expansion, fiscal policies that are coming in, both of which are extraordinarily destructive to the value of currency. And so I believe we've already seen the first innings of this shift. If you look at when we last spoke, we talked about oil. Okay, so oil's one of the components behind this, but you've got the amount of capital that is now going into value stocks as opposed to growth. That turning point has already been, we believe it's been hit. It's going to be bumpy. It can come back down again, but we are confident that secular and cyclical change has taken place. And where people are missing this is they're looking and they're saying, in order for us to have capital go back into value and to go back into commodities, we have to see growth. Because the last time we've ever experienced bull markets in commodities, for example, has been as a consequence of growth. It's been emerging market growth. It's been the rise of Asia. It's the BRICS, etc. Mm-hmm. This time, that's not happening. But this time, we're going to have an extraordinary bull market in these as a consequence of supply destruction, not as a consequence of demand-led growth. And so everyone's looking at the growth and going, the world's shut down, and there's many people have gone out of business. There's less growth. I get it. I get all of that. But what you've had is more supply destruction than you have of growth. And it's all taken place at the very tail end of what was a pretty bloody brutal commodity bear market. So that sets us up for a phenomenal next decade, I would say. And anyway, so that's kind of, I'm just rabbiting on. That's the broad.
No, I love it. I love the explanation. I love the explanation of that. So let's get into the commodity part. And also, We'll throw Bitcoin in there as well. I want to share something, and maybe we can start with Bitcoin before we get into gold and oil and different commodities and stuff, which I know you've been invested in and doing very well on. But on your website here, Capital Exploits, guys, just scroll down here to your blog, and you have something interesting here. So it's 13 reasons bulls are wrong. Now, I want to bring everyone in here before I say anything.
Got a bunch of hate mail for that.
No. But you are not a permabull or a permabear. It's one of the things I love about you, because when the facts change, you change. Where we don't see that a lot. We don't see it often, especially with gold bugs. It's buy gold no matter what the market is. You were one of the early adopters of Bitcoin. You still own Bitcoin now. I mean, you're talking about 2014, and I don't think you've sold any, if I read that correctly. So you're just pointing out, hey, why Bitcoin could go to 100,000, but here's some serious risks, because when you see things at all-time highs, people kind of forget the risks, and you're a guy that always looks at the risks. I believe you look at the risks first, and making sure that they're manageable and that reward's going to be that much greater, right? Risk reward, asymmetric investing. But talk about that story on Bitcoin. And I don't want it to be where, hey, you're going to get hate email, because you've been right, you've been bullish on this, and you still own it. But to me, I read this piece as someone that really knows this industry that's saying, hey, just be careful here. It's getting, a little crazy.
So Bitcoin's been one of those things. Look, it's easily been the most asymmetrical investment I've had, and I've had a bunch. So we ran an event where we got investors into it. I was still really trying to figure it out, but I had sufficient. We had sufficient information at the time that led us to believe that there was it was a decent risk reward bet. Okay, and it was about $450. So we treated it like you would treat any other venture capital type of investment, where you say, you know what, there's a good probability this thing goes to zero and it doesn't work out. So I'm going to risk, my weighted investment is going to be risk adjusted for that probability event. And then as things transpire, well, we know where we're at now. And the other thing that the main thing that I've been waiting for, because like I rode it all the way up to 20. I let it crash back down, and I didn't sell. I didn't do anything. I added more, a little bit more when it dropped down to like 4, and then at about 6.5, I added some more. But anyway, the long and short of it is most markets go through cycles in terms of new technologies, if you will. Ordinarily, what happens is capital will go into a sector via family and friends, and it's a bunch of kids in hoodies drinking beer in the garage, making whatever it is that they're making. And so they ask mum and dad for some money, and then friends come in, and you kind of slowly build this up until you have something, and then you have angel groups will come in and invest into that technology or that sector, and then once you get more traction, often liquidity events in that. Larger companies will buy out these smaller companies in whatever the new technology is. And now you have some liquidity events, you kind of have traction, you can see the runway. That's when the venture capitalists start coming in. So the VC firms will come and they start putting money in. And then you get a few liquidity events, either in the VC world where they're selling them to other funds, or where they're actually getting listed and they're actually becoming public. And then as soon as you get some of them going public, now you have the brokers come in, and the brokers go, okay, cool, I can start selling this to my retail client base. Or if it's IPOs, then they'll sell it to their accredited client base. So now you kind of got broker participation, and the bull builds and builds. And the sort of tail end of that is when the investment bankers look at it and they go, hey, we've got a whole new asset class here. It's a whole new sector. Let's go and make some money, because at the end of the day, they'll sell anything. They don't give a shit. So now they'll take this new asset class and they'll package it up, right? And that's when you'll get indices or you'll get ETFs, right? So you'll have a new ETF that's listed and it's for solar or it's for whatever, okay? And what they're doing now is they're just making it super easy for the retail investor to come in and go, I want that. I've seen that that's done really well over the last 10, 15 years or whatever it is. This is clearly that I have to be involved. Here's an easy way for me. Click of a button on my Robinhood account and I can buy it. That is often the tail end of that particular bull. because who's going to sell? Who else is there to sell to? So that whole transition takes place regularly and all sorts of things. Now with Bitcoin, what we actually had was we missed the entire corporate component in the last, when it ran to 20,000. The reason I didn't sell and I remained bullish, I looked at it, I was like, I understand charts. I'm like, this is nuts. And I expected volatility, and I actually didn't expect it to crash as much as it did, but hey, whatever. I was like, this is a massively volatile asset class. But what I wanted to see institutional participation, because we didn't have it yet. We had retail participation, but predominantly actually from like a select niche group. It wasn't broad retail participation. Everyone was like, after it ran to 20,000, a lot of people were like, oh, well, every joker and the shoemaker was buying Bitcoin, and that's bullshit. It wasn't actually that extensive. Part of it is just the free float of Bitcoin is so tiny. So you had retail participation, but not broad retail guys with a Robinhood account participation. So that whole retail component had not taken place. And commercial or institutional participation hadn't taken place at all. So that's now happening. That's what we were waiting for. That can easily run a bunch, and can it go 10x from here? Possibly. But the points that I made in that blog post, I think, are all relevant. There is this, while that's taking place, central banks have a huge issue. They have to resolve their debt, which is unsustainable, unpayable, and they are increasingly owning much, much more of the bond market. We've seen this. Japan basically owns all the bond market. There is no functioning bond market in Japan. Europe, there's increasingly no functioning bond market in Europe, because 100% of all secondary issuance is bought by the central bank, and about 85% of first issuance. So that's not a participating market. So the reflective interest rates are incorrect. They're completely mispriced. So, and they're going to have to keep doing that to the extent where they're just going to own the entire bond market, and it's just Peter paying Paul. It's a nonsense story. So they realize that that's not going to get them anywhere, and ultimately the mispricing of real interest rates, the market starts pricing them anyway. For example, when you look at ECB rates, if you look at the German bonds or anything else, and you go out and you want to borrow money to start your business, you're not paying those rates. You're not paying anywhere near those rates. So the disconnect gets broader and worse. Now, so the answer for these pointy shoe bureaucrats is to actually repudiate that debt and to issue or usher in a new central bank digital currency. When that happens, they will not want to have any conduits to get out. In other words, because what it is essentially, Frank, is capital controls. If you think about how we've got capital controls in the third world, they shut down the borders, right? And they won't let you cross the border with a bag of money. That's their level of capital controls. They don't need to do that anymore. Everything's digital. So they've got to do the same thing in the digital world. So in the digital world, they don't want you to have an ability to escape their new system. And Bitcoin is an escape valve, which makes it kind of asymmetric, because as they look to bringing that in, there would conceivably be a lot of people who go, holy shit, I don't trust this new central bank digital currency that's being issued. I don't want my cash being converted into that thing, and I'm out. And so I'm going to choose other avenues, and there could be many avenues. You could be buying gold, you could be buying oil, whatever. But one of those avenues certainly is Bitcoin, and I don't think it's reasonable to expect them to allow that. And so, while I'm aware that you can't ban it per se, you can easily ban people using it. And if you think that people are going to repudiate that and say, well, no, I'm going to do it anyway, then you haven't been looking at the world over the last year, because they just told you to lock yourself under your pillow for what clearly, evidently now, is not much worse than a seasonal flu, to wear double masks, to take experimental drugs into your body, and people are doing it. So to think that people wouldn't turn around and say, no, I'm going to actually use Bitcoin and the hell with you, I think is flies in the face of the evidence of what we've seen over the last year. So that actually has made me far more bearish. If we'd seen a different response to these tyrannical, draconian measures being taken, then one could think that humanity actually had some sense, and we could have a way forward with some, it doesn't even need to be Bitcoin, but any other sort of free, decentralized monetary system. But at this point in time, that doesn't, unfortunately, tie in with what's taking place.
No, that makes a lot of sense. And I love that, because everyone right now is really bullish on Bitcoin. And it's just nice to see someone who's been bullish on it saying, hey, just there's things to worry about here, and just the government and things like that there are definitely risks to it. Everyone's just like, it's going to 100,000 more institutional adoption. But one of the areas that has, I don't know if it's because, people choose between Bitcoin or gold, but I would think from your standpoint, in a market where you're seeing inflated valuations almost in every single sector, right? Even the so-called value growth, transition from growth into value, and all these reopen trades, where the cruises are trading at higher valuations than they were pre-COVID, and they still don't have any ships in the water yet, the three biggest ones. I would think gold here. I remember you coming on the podcast, I think it was 2017, you said, look, we're investing heavily for credit investors in junior miners, and they surged off their lows. But over the past year, they significantly underperformed the market. Not just juniors, but we look at even the majors, right, in gold. So is this up your alley where, to me, when I look at gold, I like buying things that are hated. Everybody hates gold. Nobody wants to talk about it. You can't sell anything gold related. But I think people don't understand that last year, 2020, they reported record profits. So you're seeing growth. We're not just buying value and hopefully growth's you're seeing it. I mean, the margins that they have, the growth that they have is incredible. Yet it still seems like this is an industry that's relatively cheap, especially from the majors and the producers. But is this something that you're looking to invest in? Does this check off all your boxes in terms of, your investment style, which is, hey, we need to see, massive rewards here while taking on as low risk as possible?
Yeah, I mean, look, everything goes through. Again, we're at the first innings of this major super cycle in commodities. And so it's not going to be linear. Don't expect it to be linear. And the smart thing to do is actually just to be very patient, not get overly excited with anything, build a portfolio that has multiple positions across multiple sectors, and literally be right and sit tight. Now, I know that's boring for most people. Much of what we do, my positioning for the last 12 months, 2 years, hasn't changed a whole lot. It's changed a little bit, but broadly, we don't churn our portfolio very much. We don't dive in and out of things. You be right, you sit tight. You keep analyzing what you hold. If you're holding it and it doesn't make sense to hold it any longer, you get rid of it, and you either replace it with something that's a better asset, or you reallocate into another sector that might have more asymmetry. But by and large, you don't do a hell of a lot. With respect to gold, we're having a bit of a pullback. And look, we could have a short-term liquidity event. This is the biggest risk, and a lot of clients will come to me and say, wow, I'm really worried about the market. Should I wait and maybe we dive in, after some sort of crash? And my response to that is always the same. What is the crash? If we get a crash, and it's not given that we will, what does it look like? Is it a crash in bonds? Is it a crash in bonds and equities? Is it a crash in, what is it a crash in? Because remember, when something's crashing out, it's got to crash against something else. In other words, an equity market crash is actually just a bull market in the dollar, or vice versa, right? Or some other currency, because what's crashing against? What's crashing against currency? So then I would ask the question, if you're worried about a crash in the equity markets, and again, this is a broad equities, like we're not in the broad equity market. We don't own the S&P. We don't own the NASDAQ. We're very, very select on what we do own. But if you're that guy and you've got broad mutual fund exposures to a bunch of the indices, you're looking at it and you're saying, okay, I'm scared of a crash. Well, here's the second question. If you want to get out and go into cash, how long are you going to own the cash for? Because we've just had roughly 4 trillion just in the United States alone. That's stimulus package, which is roughly 40% of the existing Fed's balance sheet. Would you want to own cash when that's taking place? That doesn't inspire me with confidence to want to own dollars or to want to own bonds, which is ordinarily in some crash you would own bonds because they would outperform your equity positions. So, when you look at what you can invest in, there's a huge problem here. On a long, like our time frame is 5-10 years. What happens in the next 6 months, I don't know, and I don't really care too much. When I look out 5 years, it's much more clear and much more evident to me where we're going, and I need to be positioned for that because that's critical for me. It's critical for me. It's critical for my family. It's critical for my clients. So when I look at that, I'm like, I don't want to own dollars. I don't want to own euro. I don't want to own any of this garbage. It doesn't make any sense to me. Aside from the fact that the euro looks like it's going to be replaced with some digital central bank currency, and almost certainly what they'll do is what they did when they introduced the euro, and a bunch of the countries actually just got closed. If you were in Portugal and you suddenly went to the euro, you found that a lot of the things that you were going to go and buy on the street was actually cost more expensive because they actually just they did a semi-Nixon on you. In any event, you don't want to own cash. You don't want to own bonds when we're at 5,000-year lows in interest rates, the highest debt levels the world has ever seen. Buying into that makes no sense to me. So you say, well, broad equities? No, I don't want to own that either because you've got, again, S&P, 25% of the S&P is a bunch of companies, the top tech companies, which are running at valuations that make blood want to shoot from my eyes. So it actually becomes quite easy for me to look and say, well, the stuff that I want to own is actually all this deep value, cheap stuff. And incidentally, it happens to be the very goods and services that are pretty much critical to humanity, whether it be copper, nickel, natural gas, coal, and from the precious metal sides of things, gold, silver, all of those fit into a broad portfolio. So, you asked specifically about gold stocks. I'm not worried about them. I expect that they'll have some volatility, but I'm going to hold them for the next probably 5-10 years. We'll see kind of how that cycle goes. So don't hold me to that, but broadly, that's what I'm thinking at this point in time.
No, it's interesting.
And there's some exceptional value out there because the supply, again, we're coming out of a bear market in commodities, and you and I both know this. Mm-hmm. This is a super capital intensive business. It's also predicated a lot on investor emotions, and in those investor emotions for the last 15 years, or in 2012 was kind of the end of the last cycle. Nobody's wanted to go near this stuff. Now that's changed in the last 2 years. It slowly started changing. 2019, 2020. It's now. You're now at a point where, if you're getting into, for example, into private placements, you got to fight. You got to fight a bit to get placements. That was not like 2 years ago. You could name your price. You could do whatever the hell you please because these poor guys could not get financing at all. So again, there were first innings in this phase, but there's no broad participation. And again, we're going to forget about retail because they don't matter that much, but we're going to get institutional ownership coming in where they're going to, they're just going to bid these things up, and there's so few assets left.
So one asset that you didn't mention, which I know that you've liked for a while, is uranium. All of a sudden, uranium has been, the trade. Everybody loves it, right? They hated it when it was really cheap, a lot of these stocks. But now you're seeing supply-demand imbalances, things that you cited, things like Michael Alkin cited, some of the brilliant minds in this industry. Now you're seeing some of these stocks move incredibly higher. And I still feel like it's under the radar. You're not hearing uranium mentioned at all in the financial media, right? You see it on social media from uranium bugs and stuff like that. Where are your thoughts on this? And could we still continue to see a lot of these stocks move higher where the surprise for me and what we saw at oil, right? Oil prices rose incredibly, right? So that's an influence in those stock prices and eventually profits for those that are producing. But prices haven't really been moving higher in uranium. Does that make you nervous, or you think, hey, that's got to come based on a supply-demand imbalance by so many countries and so many companies just cutting off production, and with demand really coming online now for alternative energies and green fuel, especially international? I want to get your thoughts right now today as someone who's done very well in the uranium market. Do you still think this trend has legs?
We're still long. First innings in it. I mean, the dynamics of that market, if we strip out the greenwashing, which is what I call it, because renewable green energy is both, when you look at the dynamics of it, it's neither green nor is it renewable for the most part. That aside, we're going to still play this game. Politicians are still going to pretend that it is what it isn't. And we're still going to have an extraordinary boom. That dynamic did not exist in the previous bull market in uranium. So there wasn't the pressures towards a green economy, and yet we saw multiples of what we've already seen. So our positions were up about 800. I think it's about 800%, somewhere there. But if you go and you have a look for market cap adjusted, the companies that we've got in our portfolio, but you could take pretty much any, you just go and get a string of uranium companies and track them on a market cap adjusted basis, and you'll see we've hardly moved in this. We really have hardly moved. The reason that you can go up 800% and really actually hardly moved is because they were absolutely decimated. We've got roughly 90% of the companies that existed in the previous bull went away. They're gone. So the supply side got crushed. And again, this time around, we've actually got a demand side that is really extraordinary because it's being led by this green initiative, renewable energy bollocks. And so that's going to push a lot more capital into the uranium space. That's just one component. Then the other component that you've got is actually within Asia in particular, India, China as well. The amount of capital that's going in and the amount of reactors being built and everything else dwarfs anything that we've seen before. So I do think that we have an extraordinary setup. The best time, I guess, was to invest 18 months ago, when it was still, in fact, the best time to invest was in March when we had that initial sell-off, or the Corona sell-off. And I have
this is a uranium ETF up here that I'm showing while you're talking, just, an overall ETF, but just to show, the huge growth. But again,
is that URNM?
This is just URA. So I just brought up, some just to see a broad range of how good this trade has been, especially over the past year, which again, not too many people are talking about, right, Chris?
Well, just on that note, because that's a garbage ETF. It's a horrible thing. There's another one that's been listed called URNM that I would suggest listeners go and have a look at. What happened with URA was and this is interesting to watch with cycles. Look, ETF providers make money based on volume, and they make money based on assets under management in that ETF, and they clip the ticket. So you pay 50 basis points or 28 basis points, whatever it is, depending on the ETF structure. But by and large, they need to have a lot of capital into that structure. So the individual equities that got hammered in what was URA, meant that the amount of your capitalization was so small. So these guys weren't making much money. What they did was they went and changed the structure of URA, and they started throwing in a bunch of companies which actually aren't really uranium companies, but they had larger market caps. So you could chuck in something like Mitsubishi because it has some freaking R&D department that's got some uranium component or whatever. Anyway, so they threw in a whole lot of stuff that was not really specifically uranium related, but it allowed the market cap to be greater, and hence they could earn more fees. So you've got to be careful with that. But that's actually a really good indicator of what you get at the bottom of a cycle, right? When they either delist an ETF because it just doesn't make sense for them to own it anymore, like they did with SEA, which is shipping, another one of our sectors. They delisted it. They're like, oh, fuck it, no one's interested in shipping. We're not going to need ships anymore. And so they just delisted the damn thing. So now you actually can't get exposure to shipping without going and buying individual equities. That's great. That's a good thing. It just means that there's less participants there. Anyway, back to uranium. So with uranium, that whole ETF is garbage. There's a new one that just got listed called URNM, which is a better proxy for uranium if investors desire to go after it. But you'll see the same sort of thing. I mean, you're not going to get the price history on Uranium because it's only just been listed. But I mean, look, you could just take Cameco if you want to kind of Cameco tracks uranium spot relatively well. So if you're kind of trying to get your head around from a 40,000 foot view, what does the uranium market look like? I'd use Cameco as a proxy, and then if you want exposure and you don't have the skills or don't want to go and pick individual equities, I would go for URNM as opposed to URA. But but no, I think the sector is going to continue to do well for all of the reasons that the entire base commodity sector is going to do well, but especially as a consequence of green funds, if you want to call them that, that are going to come out and they're going to invest into the space. And now what you're seeing is some of the companies are going out and buying ahead in the spot market because they're realizing, oh shit, we don't have supply. And so that's an interesting change. I read about, I think it was last week or the week before in one of our notes to clients. But yeah, we're long, we remain long. I anticipate we'll be long for a few years. We'll watch and keep our eye on it. But
now, Chris, when you say you're long, is it through North Shore Global Uranium? Is it through individual companies? Is it through private placements? Is it Cameco? Is it NextGen, UEC, Uranium Royalty, which is a new royalty company in uranium? I mean, when you say long, is there any specific ideas that you could share? And if you can't, I understand 100%. But just for some of our listeners out there, when you say you're long, what are some of the good investments out there? Is it you're long just the price of uranium and maybe play it that way through the options market? I'm just curious how, where do you see, the separation in companies?
Sure. Yeah. Look, for starters, we don't use leverage. Very, very rarely do we use leverage. So, options, we never do futures contracts. If you think, and this goes back to, look, we're deep value investors, but if you go and you look at long-term cycles, sure, your futures traders can do well, but like for your average Joe, the best thing that you can do is just bang, you hit that sector and you just hold on for the ride, and you want to get at least 80% of that ride. You want to get the meat of it. And when things get nutty, start sort of tapering off and realize, and I'm not very good at this, but realize that things are going to get even more stupid than you think they will. So when you're looking at stuff, going, that doesn't make any sense. It can easily double or triple from there. but the risk behind it, of course, is you need to be cognizant of risk. So anyway, and to a certain extent, that's what I feel like Bitcoin's a little bit like now, right? I mean, we're up an astonishing amount, but let's say we weren't. Let's say we got in at, I don't know, 6,000, which is not that long ago, right? You're still up like 10 times, right? So you got to look at it and go, okay, if I took that capital now, where can I get a 10 times return? Is it in Bitcoin? Or would I go and buy nickel miners, where we're going to need, by all accounts, at least at the very minimum 4 times global supply to meet the initiatives of many Western governments in terms of their 2030 protocols of green energy. So everything's like kind of looking at it as a broad perspective and going, don't look at it in isolation. And I think that's one of the problems that you have with gold bugs or Bitcoin bugs or whatever, is they kind of live in their little isolated world, and they get fixated on that one thing. It's a bit like a teenager with a girlfriend, and you can only see that girlfriend, and she's probably a pain in the ass, but it's like there's other girls out there. Have a look around. But anyway, on uranium, I mean, look, the way that we go about this, Frank, is quite simple. We want to get exposure to a sector. We're cognizant that you can pick the best company, but some things can go wrong. Remember Cameco's Cigar Lake flooding. I mean, it was a good company. Could you have foreseen that? No. Even the guys who were working on the bloody project didn't foresee it, obviously, right? And so there's all sorts of things that can take place. It could be geopolitical risk. You could have a war breakout. You could have government regulations that come in. There's a lot of different things that can upset what would ordinarily be a very, very good investment. And so we like to have a broad diversification. We basically look at that and we say, okay, let's break that down. Let's take our uranium sector allocation. We want to have roughly 50% of that in companies that we don't think are going to go away, right? So these are your Camecos. Or the ETF that I mentioned, uranium, kind of gives you broad exposure. And then the balance of that, we will go and look and say, okay, what else could we put in here? And we'll get geographically diversified, and we might take risk in that we'll go into companies which might have a resource that is not yet developed, right? So it's in-ground resource. We know the resource is there. Maybe they balance. Maybe they've got 3 years of cash in the balance sheet to go, okay. But where that resource, if it comes into the money, is now very valuable, and the share price would reflect it. So you can have something that goes from 10 cents to like $5, but you're taking risk. So we kind of break that down. Ordinarily, we won't take any one position. That's like, we're often 1% AUM on an individual position. So it's not so much about it is what you pick, but it's about risk management. It's about portfolio management. That's what people need to do better, I think. But I could throw out all sorts of names. Energy Fuels, I think, is a good one, which tickers UU. Or is it? I think it's 4 U's. Anyway,
I think it is 4 U's.
Get that mixed up. Yes, you. We own Bannerman. Bannerman's probably got the best management team, and I can think of, like, great CEO. Their resources is not amazing, but I've seen amazing resources run by shitty management teams and they don't work, and I've seen average resources run by amazing management teams and they work. People are important. Yes. What else? Paladin we own, Boss Resources. You could, but look, again, if you're just trying to get broad exposure, that new ETF Uranium, I think, is a decent proxy to get into that space. But there's some other ones that we own that you can have a look at.
No, that's great. Thank you so much. Thanks so much for sharing those ideas too. So I know you've been early in that trend, just like a lot of other trends. And I know you made my investors a lot of money. So I really appreciate you coming on the podcast. If someone wants to learn more about you, you go to your website or follow you on Twitter. How could they do that?
Yeah, you can. I'm less active on Twitter these days than I have been in the past. The hell with the Silicon Valley overlords. I've gone off I've gone off Facebook. I've de-Googled everything. And Twitter sort of still hangs out there. But no, I mean, direct on my website, capitalistexploits.at. And occasionally probably write a bit less than I used to on the free blog. Just very, very busy these days. There or Glenhawkey Capital, but that's just for accredited investors. And that's we do personally managed accounts for people, but which is actually just our portfolio mirrored. Yeah. So that's how you can find me.
That's great stuff, Chris. And again, I really appreciate coming on from New Zealand. Like I said, we always get, I don't know exactly if you're always in New Zealand when we do these, but I know there's a big time difference in terms of it's a different day. So sometimes we get a little confused with timing and stuff, but I really appreciate you doing this, and you've done a hell of a job for my investors. You always come on, you always bring it. And I really, really appreciate that, man, more than you know. So thank you so much for coming on and giving these guys ideas, and more important, giving them ideas where they've made money on, because that's what this podcast is about. So I appreciate it, buddy.
You're welcome. It was good to see you and good to chat. And, it'll be awesome to actually do one of these in person, but
hopefully soon.
that's looking like it's a problematic scenario ahead of us. So we'll have to just see how that one pans out.
Yeah, absolutely. Absolutely. So, all right. Thank you again for coming on, and we'll talk soon.
Take care, mate. See ya.